I think the main difference that we've wanted to affect is that so many of the companies we invest in through that kind of traditional seed investing that happens that kind of feeds up into the bigger VC culture, so much of the advice and so many of the tactics that they implement are really designed around the next fundable milestone. So rather than kind of creating the kinds of companies that necessarily they're best equipped to build or chasing the opportunities they're best equipped to pursue, so many of them make these trade-offs around the markets, the tactics that are going to drive the next round of funding and increase their valuation versus create a long-term durable business. And so after, I've been in the venture business now for 15 years, seeing this trade-off between what they want to be building and what they have to build to kind of get the support they need to be able to scale, Indie.vc kind of fell out of a lot of those conversations. And so when I think of what the profile is for an Indie.vc-style company, we're trying to distill that down to companies who look to get profitable quickly or who are currently profitable and who want to kind of explore what that next level of growth looks like that they can't fund out of cash flow.
Yeah. Well, so I was sort of immediately attracted to Bryce's idea of Indie.vc because O'Reilly itself was an Indie.vc-style company. We were started with $500, basically started selling services and eventually selling books and selling conferences, effectively doing things that people wanted. And it's a very different kind of business model. And it's led us to different choices as a business. But there are a lot of other companies that have actually succeeded at this model, even in tech. Can you maybe mention a few of those who've been inspirational for you?
Yeah, so part of what we're doing with Indie.vc is we're trying to provide companies who aren't interested in having or would like to avoid that kind of traditional VC playbook for as long as possible. We're trying to give them access to a little bit of capital and a lot of mentoring. And so this last week we spent 2 days in Chicago, kind of what we call our quarterly retreats, and we spent time with a lot of founders who are building companies in that vein. One of the companies we spent time with was one that is called Basecamp, run by a founder named Jason Fried. Basecamp was started years ago as part of a consulting firm that's now developed into a full-fledged SaaS product that is generating tens of millions of dollars a year in profit, never taken any outside funding that went to the balance sheet. And we see that happening a lot. I mean, even if you look at one of the pushbacks we've had is that ambitious people just don't build businesses these way, or that by not raising funding, you're somehow handicapping your opportunity. But if you look at the last 3 kind of acquisitions of consequence of private companies, you had Otto, which was about a $700 million acquisition by Uber. That was self-funded, no outside capital for that company. Media.net was a $900 million acquisition that was recently purchased. And then another one recently was AppLovin, which was bought for over $1 billion. And in less than 4 years, with no VC funding, they were able to grow and scale. And so I think a lot of the conventional wisdom we kind of take for granted around what it takes to start and scale a business, given the dynamics of online resources and open source software, so much of that cost and inability to scale has been removed in terms of dollars.